So I wanted to give a quick overview of the Fed meeting that literally just ended. The primary story here is the Fed's policy rate projections, of course, known as the dots. This is a Fed clearly on course to cut rates much sooner than later. Our view has been and remains we'll get the first cut, first of three cuts, actually, starting mid-year. And if anything, after a press conference like this, we feel very comfortable with our longstanding view. I think we're going to talk about a few other things within this meeting today. I think the current year dot is probably something we should talk about. This was there was a bunch of uncertainty around this. What would they do with it? Would they take basically the three cuts that they had built in for the year and drift it down to two? They did not do that. They kept three cuts as their forecast for the year. And I think what's most interesting is it came with an inflation forecast that was actually higher in the current year. Which I guess really drives home how worried they are about inflation and the fate of cuts on the back of that. Powell several times used this phrase that inflation will slow over time. In fact, he even acknowledged some seasonal quirks were likely at play, excuse me, in the recent inflation data, which again we've been highlighting quite a bit. This is a Fed that will need to be very surprised by inflation on the upside to back away from what they're projecting for cuts this year. Stated differently, given what we heard from Powell, the hurdle to be surprised seems to be really high. So three cuts remains our call. Two more things to talk about really quick. One of them is the long run dot. We have been flagging that the long run dot seemed primed to move higher. It did today. It was modest increase. It went from 2.5 to 2.6%. But I would highlight, it came from some holdouts that were incredibly low in the stack of forecasts. It looks like some folks that were forecasting 2.375%, they shifted their forecast higher. That's all well and good, and I think that at 2.375%, that number was entirely too low. But I think there's more to come there. So watch for the long run dot. It's going to continue to move higher. I think if I was to say anything else, like as a sort of a final thought here, if I was to take issue with what was presented today, if the backdrop they penciled in for next year is realized, which is to say a pretty nice economic outcome, there's no way funds will be at 3.9% by the end of next year. We think it will be much closer to a neutral rate of, call it around 3.25%, and that's pretty much our call.